In our previous video, we did some of the ratios related asset utilization, and with that previous video, we did some of the ratios related profitability and return ratio. In this video, we'll be mainly covering related with leverage ratios. Another thing is liquidity ratio. This ratio also very important, super important when it comes to a specific company. So let's calculate one by one. First, let's calculate the total assets to equity ratio. So we can find the total assets from company balance sheet. Also we have a total equity. So let's move forward. For the equity, we can find the total equity here, total shareholders equity. Yeah, now we have a 2.5 2.5 total assets we have for one USD. So this is bit good for the company. And also another calculation is total liabilities to equity. We can get the total liability from here in this balance sheet. So finally we have around 1.5 total liability. We have only one USD of equity, so it's relatively not good, but we have to improve the total liability levels a little bit more. So so another thing, let's go to the debt to equity ratio. For that, we can take the total interest bearing liabilities only. This interest bearing liability would be included interest bearing current liability, also interest bearing long term liability. So we can add whole liability as well here. For the total equity, for the total equity, we have around 0.78. It's a little bit good, but we did for the equity we have a total liabilities 1.5, but for the equity interest bearing liabilities only we have a 0.78. So okay, fine. Yeah, and let's calculate the debt to EBITDA. We can get the interest bearing liabilities from here. Also, we can get the EBITDA from income statement. We all know very well. EBITDA. Okay, it's relatively 1.78. It's a bit higher. Another ratio we have a net debt to EBITDA ratio. Yeah, when it comes to net debt to EBITDA ratio, we all know how to calculate net debt. We can calculate the net debt in interest bearing liability minus cash. Yeah, we can get the case from balance sheet. Yeah, we can get the case from balance sheet here. Also, we should get EBITDA. It's around 1.52. So let's we calculate all the ratios, related leverage, and now do one thing. Select all, control R. Now we have calculated all the ratio for 5 years. Yeah, this good. And now let's move forward our liquidity ratio. The liquidity ratio is very important when it comes to the day-to-day activities of a specific company. Let's calculate first. Liquidity ratio is current ratio. We can take the current asset from balance sheet. Also, we can take the current liabilities from here we can calculate current liabilities. It's relatively 0.9. So yeah, another ratio we have under liquidity ratio is quick ratio. To calculate the quick ratio, we should subtract the inventory from current asset. Here we have current assets minus inventory. We can find the inventory in the balance sheet. Okay, we found the inventory as well. Let's add the current liabilities. Here we have around 0.24, but in the current assets mainly we have a large amount of inventory. So let's let's move forward for our interest coverage ratio. For that, let's take the EBITDA. Denominator is our interest expenses. We can take this from our income statement. So this is not good. We have to change this as a positive. Yeah, we have interest coverage is around 14.57. So we have calculated all the ratio related liquidity. Yeah, copy all and control R. Yeah, now we have calculated all the ratios under liquidity. So this is our ratios that we have calculated. This is our benchmark. So up to now we have calculated ratios related profitability and return ratios, asset utilization ratios, leverage ratios, and liquidity ratio. So mostly we have calculated all the ratios. In our future videos we'll be calculating the DuPont analysis. That's very super important and super interesting part. So this all about the today video. Let's meet in our next video. Thanks.